Hello, Brian Manier here, founding and managing partner of Keystone Financial Group. This is the third in a series of short video tutorials designed to cover the most important topics to help you better understand Bank on Yourself and the practice of using specially structured whole life insurance contracts to build a financial foundation. Let's start by talking about something called the velocity of money. This is a technical economic term that describes the movement of money between parties, making money through velocity. This is the movement of money between depositors and borrowers using the same dollars to serve multiple functions simultaneously. The unique features of whole life insurance contracts, combined with non-direct recognition policy loans that we discussed in the second video, allows us to increase the velocity of our own money by getting multiple uses from the same savings dollars simultaneously. To better understand this, let's discuss something called the interest equation. When we make a major purchase, we either pay cash for it or we borrow money to make that purchase. When we pay cash for it, we save our money over time, probably in a savings account, until we've accumulated an amount that we need to make a purchase. We then withdraw that money from the savings account, depleting either a large amount or all of that savings down to what we call the zero line. And then we begin accumulating savings in that same savings account until, again, we need to make another purchase, and so on and so forth. On the other side of the coin, we can also make that purchase by borrowing the money all at once, and then over time, we slowly repay that loan back to the zero line. And then we borrow the money for the next purchase and slowly repay that back to the zero line, and so on and so forth as we move through our lives. Now, it's interesting when you look at this that both paying cash and borrowing are really just mirror images of exactly the same process. Now, you might be asking, well, what about the interest on the borrowing side? And of course, we all know that to borrow money for the privilege of paying back that money over some time, we'll pay an interest rate to the lender. But what most people don't think about is that when we pay cash, we're also paying interest in a way, and that's because everything you buy is financed. You're either paying interest to borrow money or you're giving up interest you could have earned on the cash you spend. So the real conundrum is, how can we buy things that we need or want in our lives without giving up the future value, which is the compound interest on our savings dollars? Bank on Yourself is a solution to that conundrum because the unique features of the whole life contract and because of non-direct recognition policy loans, we have the ability to use our money for the things we want or need. When we use and repay policy loans to buy things, we never go back to the zero line. Thank you for your time and attention. And on our next video, we're going to summarize and pull all the pieces together of where we are so far. So I look forward to seeing you on the next video.